The macroeconomic headwinds are building in the housing market. Bonds have been reeling from the resurgence of the war and oil prices. The yield on the 10-year Treasury climbed to 4.7%. That's the highest in a year and a half. Mortgage rates are not over 7% now, at least partly because the federal government, through Fannie and Freddie, have been buying mortgages in an attempt to push rates lower. That's worked a bit. The spread between the 10-year and the 30-year mortgage rate is much lower now than it was just a couple of years ago, so home buyers are lucky on that front. Unfortunately, a second side effect of the war is that not only are bond yields rising, but the spread is also rising again. So after a couple of years with the spread improving, that has reversed in recent months. The spread between the 10-year and the 30-year has been increasing since February. Mortgages are getting more expensive faster than the underlying bonds right now. Mortgage rates, according to our friends at Mortgage News Daily, are at 6.8%, and that's the highest level in 12 months. So far in 2026, we've had better affordability than a year ago. That affordability has helped home sales grow most of this year. Alas, that affordability advantage is now gone, at least for the time being. I think we can see the impact in slightly fewer home buyers each week right now. So I have two rules of thumb for understanding the housing market when rates are rising. First is that consumers are more sensitive to changes in rates than to the absolute levels. So in 2022, rates changed huge from 3% to 7%, a 400 basis point move in 6 months. And we can see that abrupt change in the data that year. Now we're talking about a 75 basis point move. So it'll slow demand, but it's not nearly the shock we saw in 2022. The second rule is that when rates rise, inventory rises. When rates fall, inventory falls. So from July last year to March this year, rates eased lower and all the inventory growth of the past several years evaporated. If rates move higher from here or stay elevated for longer periods of time, then we should expect supply to build again. We discuss mortgage rates often because it helps us understand the dynamics of this market, but of course, nobody knows if rates are going to jump tomorrow, or maybe we get some good news out of the Middle East and the bond market suddenly eases again. So these conditions are not predictable. So when people ask me, should I wait? My answer is that I have no idea whether rates move up or down from here, but I can tell you exactly how the housing market will react if they do. So as it turns out, as a result of the latest mortgage market shifts, we're starting to see some impact in the weekly housing data. So let's take a look at this week's home sales, pricing, inventory, and other demand indicators to help you make the best decisions possible. Let's start with the latest pending home sales data. This was the second week in a row where pending home sales came in slightly fewer than last year by just 0.4%. So we counted 84,000 newly pending home sales for the week. That was a jump of 6% from last week, but it was a fraction lower than the same week in 2025. So like I said, it's 2 weeks in a row where that weekly pending transaction count ended below last year's levels. Just a little bit. Sometimes the weekly data is a little bit jumpy. So this chart is using a 4-week rolling average to smooth out some of that weekly noise a bit. In this view, we can see the blue line is still just barely above the pace from 2025, from July of 2025, just barely. The recent average has been 81,000 newly pending home sales per week compared to 79,000 last year. Year to date, we've counted a total of 3.6% more sales than in 2025 year to date. Our forecast for the year has been for 4% sales growth. So that last 2 weeks are under the forecast, and that's something to keep an eye on. The weekly pending data is so valuable to me because it helps us see how rapidly consumers react to economic changes, not just mortgage rates. In this chart, I've included 2022 in gray. So you can see in the second half of 2022, that's when home buyers really hit the brakes. You can see in September and October that steep decline down in the gray line. So normally sales are fewer in the autumn. That's normal seasonal pattern. But in 2022, it had a really steep drop off. So you can see that in the gray line here. Those are those big moves in mortgage rates. So as we look at the blue line for 26, we can already see a little slowdown in the data in the last couple of weeks. If mortgage rates were to surge higher from here, say over 7%, or if other factors like maybe we have a big equity market drawdown. So I'll be watching this data series closely to see how it reacts. Do sales stay better than they were in 2025? 2022 was that real shock to the system. I don't expect that's what we're in for this year. If we're lucky, we get a resolution of the war sooner rather than later, and that should promptly help American homebuyers with affordability. On the price side of the equation, the story is basically what we've been sharing all year. The median price of this week's pending home sales is still just barely above last year at this time nationally, at $399,900. That's 0.2% above last year. It's essentially unchanged from 2025. And in fact, it's only 1% more than 2 years ago. For most of the country, home prices haven't really appreciated in a couple of years. So in this chart, each line is a year, and it really helps us see how prices are the last metric to move in the housing market. Inventory builds, sales can stop abruptly, but prices move very slowly. The blue line here is 2026. It bounced along all year, up a tiny bit above last year, but basically unchanged. And that's exactly the behavior we expected for the year. The gray line here is 2022 again. Notice how that year had a couple of steps down in home prices in June and again in October. Those were the moments when the market was shocked by the dramatic changes in costs. October of 22, mortgage rates were suddenly over 7%, up from 3% just a few months earlier. So, like I said, I often say that consumers are more sensitive to changes in rates than to the absolute levels. The 2022 line here shows what I mean. So you can see in that market, it does a big downward price correction. So those were from 400 basis point moves in mortgage costs. Those huge moves stopped demand cold. Now we're getting much smaller shifts in demand. So it gets more expensive, and that will slow demand. But this is a very different market than, say, in 2022. So my first rule of thumb is that consumers are more sensitive to changes in rates than to the absolute level. The second rule of thumb is that as rates rise, inventory rises. As rates fall, inventory falls. Over the period from August of last year to March of this year, mortgage rates were easing lower, and that spurred a little demand. In the 4-year period of rising inventory, that ended. So there are now roughly the same number of homes on the market as a year ago. And if you're just tuning in, that previous era, that was this market where inventory was climbing across the country steadily for 4 years. That era is now past. There are 1.1 million homes on the market. That includes single-family homes, condos, townhomes. That's up 0.5% for the week and is almost 1% more than a year ago, about 0.7% more than a year ago. So if we're unlucky, the cost of mortgage money goes higher or stays higher for longer, I would expect this inventory to rise again a bit in the second half of the year relative to last year. So just like we've had 2 weeks with fewer sales, slightly fewer sales, the past 2 weeks have seen slight inventory growth. Still overall unchanged supply compared to last year, but that could expand a bit in the second half of the year. So stay tuned. We could have a little more supply build up. I thought I'd include days on market in our review today. The average time to sell a home from listing to contract is about 70 days now. So we track this by looking at all the homes that are in contract to close now and how long they were on the market. So that market time is only 3% more than a year ago. In this chart, each line is a year, and you can see the normal seasonal curve. So we're at the fastest time of the year now. Homes that are going into contract now, those were generally listed in April, May, and because that curve increases in the second half of the year, homes that are listed now will take an average on average longer to close in the second half of the year. Notice how at the start of the year, the blue line, left end of the chart, blue line, market time was 15 to 20% longer than the year prior. Now we're only 3% longer. So this is illustrating the same phenomenon, slightly improved demand as the pending sales growth and inventory contracting all year that we saw. If rates stay higher for longer and inventory builds, you could imagine that gap growing again this year. But not yet. Also notice here the gray line from 22. One way to measure how quickly the market was changing that year was by watching how fast DOM was climbing in the second half of 2022. So that gray line, again, consumers are more sensitive to changes in rates than the absolute levels. And you can see that shift in that 2022 Days of Market series. You can see it really climb up steeply second half of the year. Okay, that's what we're watching for now. Most of this year, demand has been better than last year. With any luck, this spike in mortgage rates is temporary, and home buyers again benefit from improved affordability. That's never guaranteed, of course, so stay tuned for the latest data, and we'll see what happens next. Thanks, everybody.